Welcome back to another edition of the Blue Chip Partners Quarterly Edge, where I have my esteemed colleague Dan Seder, who will ask me some questions so I can share what some of my thoughts are for the market in the third quarter of 2026.
Nice. Looking forward to it. So, Daniel, there's three consistent themes that we talk about. We talk about the economy, we talk about stocks, we talk about bonds. Let's kick things off with the economy. Anything notable from the second quarter? What are we seeing in the economy at this point?
Well, it's been a very eventful year so far, I would say. At the onset of 2026, I don't think anyone could have anticipated the economic impact from global conflict, right? I mean, that's certainly wasn't on my bingo card, but it's something that you always have to be prepared for. So what I want to talk through, and the two biggest things I'm thinking about today are labor and inflation. And that might sound obvious. That's what the Fed focuses on, but that's really where we have seen the most meaningful developments. So take a trip down memory lane as it pertains to the labor market, all the way back to 2025 when you kind of had the tariff tantrum kick up. Mm-hmm. Basically from that point on, we were in this low hire, low fire environment because companies didn't know what the ultimate impact of tariffs was going to be. They didn't necessarily want to lay people off, but they didn't want to beef up the workforce, and they kind of held pat. Well, as you transitioned into 2026, it felt like a lot of the same for a different reason, and it was trying to gauge the impact of artificial intelligence. Do we need to right-size the workforce because of productivity gains? Do we want to shift the spending that we would on headcount to technology? And so you were in this low hire, low fire environment for basically a year. Not to mention we had bad labor market data from a government shutdown in the back half of 2025. So the reason I say all this is because my whole tagline for the back half of this year as it pertains to the labor market is we have a much cleaner story now. If you look at the number of jobs added month to month from the jobs report, it's been super volatile month to month. If you look basically all of 2025 and then the kind of heading into 2026. But since then, the clearer picture has developed of we are steadily adding jobs. The unemployment rate's actually falling now. Part of that's due to lower labor force participation because we have an aging population. But my whole bottom line here is that the labor market does appear on much more solid footing now than I would have been confident saying even just 3 months ago. The second kind of leg of this is it's not just job additions. It's not just the unemployment rate. You still have a low level of layoffs that are happening, despite all the fears that were broadcast around artificial intelligence and any white-collar job is essentially going to disappear in the next 12 months. That's not happening. Layoffs are steady. They will always exist, but they're not blowing out in any capacity. And even more importantly to me is that you're seeing hiring start to pick back up. So when you look at something like job openings start to tick up like they have over the last 4 to 5 months, that's intentional. That's data from corporations that's signaling to investors that we are willing to expand because we have confidence in the underlying economic situation. So all of that put together, you're emerging from this low hire, low fire environment. And while I don't necessarily think we're going to have some banner year from a labor market perspective, I don't think we have to.
Yeah, but the unemployment rate is low. Job openings are there. I think when you look at low hire, low fire, that's okay, right? I mean, it's certainly okay.
Yeah, and I mean, I guess more important for me is that you're seeing the trends inflect positively, right?
Yeah, so it's all good. Okay, great. Anything else on the economy?
Yeah, the other component of this is inflation, and certainly that has been a hot topic with regards to what happened in the Middle East. Yep. So when this conflict started to emerge, the immediate reaction in markets was to send the price per barrel of oil skyrocketing higher. I mean, this is just simple supply and demand. When you stop a major shipping lane for oil vessels from being able to flow, right. That's a pretty big imbalance in supply and demand, right? Well, oil as a component of the consumer price index, even though it's only 6%, it's accounted for 35% of the year-over-year increase in consumer prices. So it's skewing the CPI figure higher by way of 4.2% as of the end of May, which I think is important to talk through, but it's also just as important to talk about why I don't think that's worth paying attention to, I guess, without sugarcoating it. I mean, Kevin Warsh, the new Fed chair, even came out and said at the end of June, he's seeing a lot more favorable price action in recent weeks. And that's all the information I need to know. I can confirm that by looking at some more real-time data as opposed to just waiting, a month lag on something like the Consumer Price Index. What I'm showing on the screen right now is actually something I showed last time we were in this forum. And it's the red line being the traditional Consumer Price Index year over year, and the gray line being something called Trueflation. Trueflation is a private third party that prides themselves on having a more real-time read on consumer prices. And while I don't necessarily agree that the actual figure that comes out of this is always super accurate, it's telling you that year-over-year inflation's at 1.78% right now. I don't like it because I want an absolute number. I want it because it can inform more quickly the direction of travel. So if you look at this chart, you see CPI continuing to climb, whereas Trueflation, the more real-time, up-to-date measure, it started tapering off as early April. So again, I'm just trying to gain confidence in the narrative that, yes, energy is only 6% of CPI. It's accounting for 35% of the increase. Depending on who you talk to, I think there's a higher likelihood of us being in an oil supply glut over the next year than there is a shortfall.
Yeah, so. And prices just recently have really dropped. So hopefully we see that at the gas pump sometime soon.
Yeah, and I think it'll take some time. But at the end of the day, if I zoom out and think about from a holistic economic perspective, you have the labor market picture that is much cleaner than it was 3 and 6 months ago. Mm-hmm. You have an inflation story that has been challenging but shouldn't derail anything from here. So I like the odds of continued slow and steady growth from the U.S. economy as we look to the back half of this year.
Outstanding. That's good news. All right, let's shift to stocks. So the second quarter was extraordinarily positive from the headline level, so call it the S&P 500, the Dow Jones. Both have broken out to all-time highs. So do you want to talk about what happened in the stock market as it pertains to the second quarter?
Yeah, and it really was an earnings story. So yes, you got some relief rally from reprieve and ceasefire between the U.S. and Iran, but I think the real star of the show was corporate earnings.
Which drive price. I talk about that all the time. Earnings drive price.
Right. And so when you look at a U.S. equity market that has, it's kind of short-changing it to say it's done well over the last few years, but you have a U.S. market that's done very well over the last few years and has all of a sudden come out and printed first quarter earnings that grew 25% plus at the S&P level. Yeah. And it's certainly, I would say there's heavy participation from the tech sector, but there's other sectors that are growing quite well as well. So you see the earnings part of the equation continue to be much stronger than I think even some of the most astute sell-side analysts would have expected. On top of that, as we look towards the set of Q2 earnings, which will really kick off in the next week or two, very rarely do you see sell-side analysts in between quarters bump company-level expectations. Traditionally, if you look back over the last 5 years, sell-side price targets and earnings expectations for individual companies, for S&P companies that is, have declined 2%. And part of that's explainable because, you want to put forth a price target that's beatable, right?
Sure.
When you see sell-side analysts bump S&P 500 companies' earnings targets by over 7%, that's putting themselves out there, and they have no reason to do so unless they do vehemently believe that that result is attainable.
They'd rather underpromise and overdeliver. In this case, they're really raising the promise quite a bit, right. And so they're going to have to really deliver, I guess, in order to exceed those expectations.
Yeah, and I think there's a high bar to clear, but given the backdrop that we talked about from an economic perspective, I do think that it's achievable.
It's doable.
It's nice. Achievable. And the other kind of portion of this is, well, after a really good run, do you think that valuations start to look a little bit stretched? And my answer to that is it depends what you're using in terms of valuation metric, and it also depends on what you mean. Are you talking about the broad market? What index are you using? Are you talking about certain sectors? And to make it very simple, there are certain sectors like tech, if you looked at a trailing price to earnings ratio, that are trading above their 5-year average. But even in the tech sector, it's not extreme. And if you were going to use forward earnings instead of the last 12 months of earnings, all of a sudden the tech sector can look like it's actually at a discount. Meanwhile, on an equal weighted basis in industrials and consumer discretionary, you have outright discounts to where these sectors have historically traded over the last 5 years.
Yeah, so we're still in line on an equal weighted basis, meaning when you're not looking at the influence that these large companies have, or let's say an overweight to tech, for example. But when you look at the average stock across the S&P 500, valuations are slightly above 5-year historical averages.
Right. Yeah, and I think that's the punchline, because I'm not going to sit here and make it all sunshine and daisies, because there's obviously going to be bumps in the road. I mean, I can call out how inflation develops. Something like equity supply. I think most people listening to this will be aware of the SpaceX IPO. There is one other large one, potentially 2 large equity offerings coming, not to mention Alphabet deploying $80 billion in at-the-market equity offerings this quarter. So there will be bumps in the road from some of the nuts and bolts stuff before you even start to think about the Fed. That's going to be likely less accommodative. And don't forget midterm elections. So there certainly is potential for volatility. And I think that the way the market is behaving right now, you are seeing some of that come to fruition. But again, I'll take it back to earnings. If earnings are coming and developing the way that they're expected to, I don't want to say that solves any problem, but it certainly goes a long way.
Sure. I love it. All right. Last but not least, bonds. We'll save the most exciting portion of this for the end. So we have a relatively stable rate environment, so bond pricing up ever so slightly. Talk to us about the bond market, Daniel. What happened in the second quarter?
Yeah, it's I mean, you can joke about bonds and being exciting, which I often do, but the dramatic change that has happened in fixed income markets this year, it can't go unnoticed, because all of the economic developments that I talked about, U.S. and Iran, labor market coming in stronger than expected, and inflation running hotter, that has a massive impact in what the Federal Reserve is likely going to do and how investors are going to anticipate their actions. So if you look at the chart I'm showing on the screen right now, the blue dashed line is showing you what Fed funds rate expectations were at the end of last year. And what it would tell you is that in 2026, we expect 2 rate cuts in somewhat linear fashion. Fast forward 6 months to the end of June, which is where we're at now. We didn't get any cuts. We're not expected to get any cuts this year. We're actually expected to get between 1.5 and 2 hikes over the next year.
And that's a dramatic reversal.
Yeah.
I mean, in a relatively short period of time.
It is. And, we have a new Fed chair. So Jerome Powell, after having been in the helm or at the helm for 8 years, handing the torch over to Kevin Warsh, who is going to be a lot less transparent, I think, in the traditional sense as we've come to know a Fed chair, at least in a post-financial crisis world. I think that's okay. He's been very explicit in his goals, and that is to manage towards 2% inflation target, not 2 to 2.5, not 3, 2%. So he hasn't outright telegraphed what he's going to do, but it's very clear that he's not necessarily worried about the state of the labor market right now. He is adamantly focused on inflation. So what does that spell? That probably spells rate hikes, trying to tamp down some of that price action that's been bubbling up over the last year, mostly due to energy. But either way, that dramatic change, by the way, it's not super abnormal. I mean, when you look back to years like 2022 and 2023, the so-called smartest guys in the room, being the bond investors, got it completely wrong. I feel like there was a period of time where we would joke about pull up the interest rate forecast function in Bloomberg and basically just do the exact opposite of what that's telling you to do.
Yeah.
So with all that said, yes, we are probably looking at a higher for longer, if not even higher interest rate environment, which can be troublesome for something like the housing market that's remained very sluggish, and buying power is continuously getting more and more challenging. But at the same time, if we want to explicitly talk about the bond market landscape, we've talked about this time and time again with regards to how starting yield has such a large correlation with your total return over a longer time period.
Sure.
So as a bond investor, I think I don't want to simplify this, but life can get a lot easier when rates are higher. Now, there are some intricacies. You have corporate bond spreads, both investment grade and high yield, that are incredibly tight at historic levels even. So you've had investors get pretty creative with how they deploy money to the fixed income market, using a lot more securitized assets and kind of moving along the yield curve to try to create this truly balanced portfolio. And honestly, I think at this point in time, when you do have the benefit of higher starting yield, you keep it simple. I mean, you focus on quality. The bond portion of any investor portfolio is meant to be a ballast. Let's treat it accordingly. Mm-hmm. So I don't think you need to get overly creative here. Stay up in quality. And if you want to take some shots, I think there are certain parts of the market that look a little bit more interesting than others. I wouldn't touch high yield bonds with a 10-foot pole. They're still trading at spreads that they haven't traded at 90+% of the time over the last 20 years. So I just don't think you are being rewarded to pay up for risk. So all in, I think that, yes, the dynamic has changed pretty dramatically as we've progressed through the first 6 months of this year, but it doesn't have to be a bad thing. I mean, you see it in bond market returns. The U.S. Ag is up about 1% this year. So.
Yeah. Great. Well, thank you for the overview. As always, it was awesome to get a recap of the economy, the stock market, and the bond market. I'll let you close this down if there's anything else you want to add, but I appreciate your insight.
No, always appreciate you joining. It makes the conversation a lot more fun and a little bit easier to walk through. But awesome. That's all we've got for this quarter. Thanks, as always, for tuning in to another edition of the Blue Chip Partners Quarterly Edge. We look forward to speaking with you all again soon.